Hello and welcome to Farm Journal Live. I'm Clinton Griffiths from the Farm Journal newsroom as we continue to track and follow the coronavirus outbreak and its potential impacts on the agricultural industry. Let's get straight to the headlines today. The Labor Department releasing its weekly jobless claims Thursday morning. It's found initial jobless claims surged to more than 6.6 million last week. That brings the two-week total to about 10 million due to the coronavirus-induced economic shutdown. The previous record for claims in a week, 695,000, set back in 1982. A heartbreaking sight playing out on several dairy farms across the country right now. Producers forced to dump milk. The problem, a big shift in demand for dairy due to the coronavirus and too much supply right now. The dumping hitting multiple states and locations as production begins to pull back right as that spring flush begins. Several Wisconsin dairy industry leaders are calling on USDA to take immediate action. They've sent a letter asking the agency to use its extensive purchasing power to buy product. The group saying while retail sales have increased in past weeks, they're now leveling off and orders are slowing. Dairy manufacturers and processors have also seen their export market decimated. And the price of oil skyrocketing today after President Trump said he expects Saudi Arabia and Russia to cut production of oil. That could dial down the price war. The price of oil soaring 25% to near $25 a barrel. It also brought other energy stocks up with it. Let's bring in Jackson Takish with Farmer Mac. And Jackson, as we try to get our arms around what's going on in this energy market, it has big repercussions for agriculture.
Certainly inextricable link between ethanol prices and oil prices. So as America stops traveling, as we stop traveling to and from work, stop traveling to and from the stores, we're using less gasoline, and that has spillover effects to the ethanol markets. So just me, myself, I travel about 100 miles a week to go to and from work. So if I'm out of work for 12 weeks, then all of a sudden maybe 50 bushels of corn, just myself, would have gone into ethanol is no longer required for demand. So that's having that spillover effect from oil all the way through to the corn markets.
If oil does increase or continue to rise, could we see ethanol track with it at all?
Certainly there'll be some pickup. I anticipate some pickup there, but it's also a demand story. So if blenders aren't creating demand for gasoline, if they're not pulling through the ethanol, there's still going to be that separation between gasoline prices and ethanol prices.
Jackson, taking a look at the overall economy, obviously we've got a lot of people staying at home. Some people, our unemployment numbers are up to 6.6 million this week, above expectations. Where do we sit as far as economic health, and how long can this economy hold on?
I think that's the million-dollar question. It's a very unprecedented. That's a word I hear more and more just every time we're talking to each other. You hear on the news, you read stories about this. This is absolutely unprecedented. So it's hard to point to a point in time and say this is going to be like that. We all know every recession is different. I think this one will certainly be different and one to be studied for years to come. We have a lot of support, I think, from fiscal stimulus as well as monetary policy. So both of those things should help buttress the economy during this challenging time. But it's going to take a little bit of time to sort of see how this plays out.
You know, one thing we watch a lot in agriculture is the strength of the U.S. dollar. It continues to hold in there compared to some of our competitors for exports around the world. Is that going to move at all given the economic challenges we're facing?
Yeah, it's been very volatile. So the U.S. dollar spiked pretty high the last couple of weeks, and it's come back down to earth. So that's certainly something that we're watching. It does affect both the prices of commodities as well as the competitiveness of U.S. goods outside of our borders. Right now, the dollar still sits pretty high. We're not quite as high as we were maybe a week ago, so that's a positive for U.S. exports. But it's going to be something to watch in the next 3 to 6 months, as that will put downward pressure on export levels.
Jackson, we continue to look for a little bit of silver lining in all of this. One of those may be lower interest rates. How do you see that rippling through agriculture over the next 6 months or a year?
Absolutely. So interest rates, the Treasury rates have fallen to historic lows. And with that, a lot of the retail rates also track with it. So residential rates on the home side, as well as commercial rates and farm lending rates. All those things give farmers an opportunity to lower their costs, tighten the pencils, sharpen the pencils, tighten the belts a little bit, and try to get some of those expense levels down. So there may be some pressure on the income side, but we're also seeing some relief on the expense side. Interest expense is one of them for both operating as well as the real estate lines, but also the lower fuel costs and lower fertilizer costs will help reduce that expense side of the ledger.
How quickly should we jump into maybe refinancing or looking at some of these interest rate breaks?
Well, it's really it's dependent on every single borrower is different. Every farm is different. So that's really a decision that each farmer is going to have to make. But certainly, it's worth looking at. Anytime, every year, when we see these levels of interest rate declines, it's worth taking a look at and making sure you've got the right products and the right mix of long-term and short-term financing to meet your farming needs.
How do you think these interest rates will impact our land values? You know, a lot of times as we see interest rates come down, we see land values either hold or go up. Do you expect that this time around?
I think all real assets are supported in value by lower interest rates. So as the opportunities or other investment opportunities are lower, then you see the same returns worth more to investors. So there's certainly upward pressure due to lower interest rates, but there's also the component of the income side. So you have to see the balance between what income can the asset generate versus what are my alternatives and what other interest rates can I invest in. So certainly the lower interest rate environment will help support and maybe even put upward pressure on real assets like farmland.
As we start talking about farm income this year, obviously we're trying to get a crop in the ground. You know, USDA came out with their expectations back in February, but that picture shifted quite a bit. Any idea of getting our arms around or a handle on what farm income could look like this year?
Yeah, a lot will depend on what exactly that crop mix is. So we got the prospective plantings report from the USDA this week, and that was from a survey that was probably a little bit before a lot of this activity with COVID-19 was unraveling. So there's some time for change. We may see a different mix of crops in the ground. There's also a lot of time left in the year before we start to think about marketing next year's crop. So there's a lot of information we're going to take in over the next 3 to 6 months. I also think the U.S. Congress was good to support farmers through the CARES Act, which was just signed into law this week. I think that has a lot of provisions in there that will help alleviate some of the short-term issues that farmers are facing with the loss of income due to lower commodity prices. So very similar to what the market facilitation program was offering. I think there's going to be some additional support coming as a result of the CARES Act.
You know, the challenge is, I think, for a lot of producers is, yes, they wrote in some things that could lead to some support, but we don't know what that support is at this point.
That's right. There's still a lot of work to do, I think, both at the USDA front as well as the SBA loans that could be, a lot of farmers could be eligible for as small businesses. So there's a lot of work to do, I think, to understand the full impact, both the impact and how these things would be delivered and the timing. The market facilitation program, I thought, was great in terms of its timing. So some was out in the spring, which we saw this year. The MFP2 payments, the final payment went out this spring, which was really important for growers. And then you'll also see maybe an MFP3 be layered in throughout the year during times that farmers need that cash injection.
You know, you mentioned the SBA loans, and a lot of that tied back to keeping labor on the farm and working. What's your perspective on where we stand with labor and being able to continue to get the work done that we need to get done in agriculture?
Yeah, it's a critical piece of the picture for agriculture is that access to labor and having healthy labor. I think there's going to be more and more focus on making sure farm workers have good access to health care as well as the right protections in place for their continued work. Right now, the supply picture for labor looks pretty good on farms. That can change, but as of now, I think the whole farm supply chain is holding up very well considering the conditions that we're working in.
All right, appreciate the insights, Jackson. Jackson Takish there with Farmer Mac. Thank you so much for helping us kind of get our arms around what's going on and the impact to the overall ag economy and the bigger macro economy issues. If you'd like to continue to follow along with our coverage, you can do so by going to agweb.com/coronavirus. And of course, keep up with us on social media as well. From all of us here at Farm Journal, I'm Clint Griffiths. Have a great day.